One of the key figures in D.C. that we've been talking about this morning is Chairman Ben Bernanke. As you know, his confirmation vote looked a little bit rocky on Friday, but over the weekend, things seemed to change and cleared up. And we even had Austin Goolsbee, the senior White House economic advisor, saying earlier this morning to us that he's pretty confident that Bernanke will be confirmed. So what does all of this mean for the markets, particularly the bond markets? Well, we have with us Tony Crescenzi. He's a strategist for PIMCO, all the way from Newport Beach, California, joining us. And Tony, good to have you back on the program.
Okay. Thank you.
Now, even though you saw over the course of the past 48 hours that it seems as if Bernanke's confirmation vote is safe and it's going to happen, has there been much damage done to investors?
Only to the extent that we see government trying to stay involved. And government involvement has been a problem, of course, for markets to an extent. It's been helpful, of course, in propping up markets, but government involvement has to diminish over time and let the private sector take off. Mohamed El-Erian, our CEO, has described the 3 stages of the rocket booster helping to lift the economy. And one of those, the first stage, would be government support in terms of fiscal monetary stimulus. And the second level of support, the second rocket booster, of course, inventory investment. That's been a big part of the rebound we've had in the economy. But ultimately, for this rocket to take off and achieve escape velocity, the private sector has to take over. And that means less government involvement. And so we want to see the government move from the driver's seat to the passenger seat. And the message on Bernanke is that they didn't seem willing to do that. Luckily, this week, it looks like they will, with his confirmation looking assured at this point.
Right, and the confirmation looking assured, but it's not certain that you're going to get the government actually out of the Fed or get the government out of any of these agendas. In fact, you may even see more, right?
Well, in terms of Fed involvement, there's a ways to go. Financial reform has yet to play out in its entirety, and we don't know how it'll end. And what I think most would be worried about if it happened is a GAO audit, the General Accounting Office audits of Federal Reserve monetary policy. There's a certain GAO audits now that are fine and dandy with markets. It's really just looking at the Fed's balance sheet or certain things that are involved in it. But in terms of accounting for monetary policy and changes in interest rates, this is an accounting we don't want the government to take. And so there is a ways to go on this, and financial reform and its progress will tell us that message.
Tony, this is Peter Cook here on the Hill as well. What is your own sense about the political pressure being applied not only to Bernanke but the Fed going forward? You talked about the proposals here on the Hill. Is it changing your own outlook about what might happen to interest rates going forward, that political pressure?
Ultimately, what's going to affect the interest rate, and I don't think it's going to be Congress and the White House in terms of monetary policy and that type of thing, it's fiscal policy. We'll see the CBO, the Congressional Budget Office, tomorrow, Tuesday, release figures on its estimate for the budget. And then next Monday, the OMB, the Office of Management and Budget at the White House, will release its budget forecast. And what we see is a very big budget deficit, even out to 2015, when demographics turn the story very terribly, or worse, I should say, from the current situation, because the baby boomers and the expenditures related to that in the entitlement areas will begin to grow a lot. So what we see out to 2015 is a budget deficit maybe as high as 5% of GDP, down from the double digits right now, but still too high. And lastly, there's something they call a primary deficit. This is the deficit minus the interest cost. It's typically somewhere near zero. That's the level that stabilizes the debt to GDP ratio in the United States. It's expected to stay around 2% or so, even out to 2015. In other words, there's going to be a very big situation to tackle in terms of entitlement spending in the out years. And so in terms of government impact on interest rates, it will come mostly from the fiscal side and what is done in terms of tackling this big deficit.
Okay. All right, Tony, that's all the time that we have. But thank you so much for joining us, Tony Crescenzi of PIMCO, on the bond market reaction to all the news surrounding Fed Chairman Ben Bernanke.